So here's where we stand today. This is looking at PV installations in the US across all market segments back to the beginning of 2010 through the end of 2013. We began tracking the US solar market on a quarterly basis with really granular detail at the beginning of 2010. Before that, we had access to a little bit less data, so we were looking at it but didn't have the same level of granularity. Still, if you try to build the chart back even further, it starts to make less and less sense, and you get into these numbers that just don't matter by today's standards. The market's been growing a lot. No surprise to anyone here and anyone operating in the market. There are a million different ways that you can cut that growth. It's been growing across all market segments. It's been growing across almost all states. It's been growing in terms of dollars invested, in terms of number of systems installed, in terms of number of companies in the market, in terms of market cap of companies in the market, in terms of number of public companies in the market. It's hard to find a metric that you can't see growth in the US solar market, short of maybe the number of module manufacturers operating in the US. In 2013, we installed 4,751 megawatts of PV over the course of the year in the US. That's up 41% over 2012. So by way of context there, the market had been growing at nearly a 100% annual clip for a few years before that. So 41% growth in 2013, that's actually a slowing of growth relative to the previous 2 or 3 years. But still, we're getting into high enough numbers now that when you see 41% annual growth, that's nothing to scoff at, certainly, and it's something I think to be impressed by. In fact, it's a little bit higher than we had forecasted at the beginning of the year, and I'll talk a bit in a little while about why that was. It's over 140,000 individual installations that were completed in 2013. Over 100,000 of those in the residential market alone, which means that we had over 100,000 homes that became solarized or went solar or installed solar in 2013. One of the most important things I think over the long term for solar in the US is to have a really strong grassroots support network. And I will say, and we'll come back to this when we talk about net metering, I think the solar industry has done, for its size, a really impressive, fantastic job in general of lobbying and fighting for its rights, particularly at the state level and to some extent at the national level as well. But that's not going to last forever, and it's certainly not going to be sufficient over the long term in markets where solar is relatively new. And so the more grassroots support we have from homeowners, from individuals who are not involved in the solar industry who just want to support solar, the better off we're going to be in the long term. And I think there's a big movement right now to leverage the fact that we do have so many people who have been touched either directly or indirectly by solar to support solar in a legislative context, in a political context, in any way that we can. Finally, it was about a $14 billion market in 2013. It depends what you compare that against to see how impressive that is. It sounds like a big number. It's nothing compared to the size of the electricity sector in the US, but $14 billion is significant. And when we say market size, that's just looking at the total value of all installed systems in 2013. That means that is $14 billion in financing that went into solar projects in the US in 2013. Some of that financing came a little bit earlier, but it's a decent benchmark. So we have $14 billion of capital flowing into the market last year, and obviously that's going to be growing over the next few years as the market grows. The other thing that is relevant, and this speaks to some extent, it's related to what I was talking about yesterday morning with regard to solar's place in the overall electricity mix, is how solar fits in now relative to other energy generating technologies. So in 2012, this is new capacity additions, right? New power plants that came online. And when we're fair with ourselves here, it's not exactly apples to apples to be comparing capacity, right? Solar has a lower capacity factor than a lot of the other technologies on here. So if we were looking at generation based on that new capacity, the numbers would be a bit smaller. Still, new capacity online is important. It's what new power plants are being built. FERC releases this data once a month, and it's worth noting if you've seen the FERC data doesn't include any DG. So it's just looking at utility scale solar. It's also a bit off on timing on some of the projects. So we took the FERC data for all other generating assets and then our own data for solar. And here's what you come up with. in 2012 rather, solar was about 10% of all new generating capacity in the US. That made it fourth place in the rank order, behind wind, which was number one ahead of PTC expiration. So that's the rush in to get an incentive that's disappearing. Natural gas, thanks to the shale gas boom and low natural gas prices and increasing natural gas in the energy mix in general. And still, there was a surprising amount of coal built out in 2012, despite the fact that I think people, the cognoscenti of the energy industry in the US are sort of calling the death knell of new coal plants. That was much more evident in 2013. So solar market grows 41% installations. Natural gas continues to grow even faster than 41% in terms of new generating capacity. We are still in the midst of a very attractive time to be building natural gas capacity in the US, and I do not think that that's going to slow down. Solar may remain in second place like it was in 2013. We're not going to hit first place anytime soon. But coal did start to slow down. I don't think that that trend is going to reverse anytime soon either. There isn't a lot of new coal capacity being built out, and there is a lot of coal capacity that's going to be retired. And then obviously post-PTC expiration, the wind market slowed down a whole lot. Will pick up again some, but I think solar should remain ahead. So solar is sitting at the big kids table, so to speak. We are installing enough new generation, both on the utility scale side and especially when you incorporate DG as well, that in terms of new electricity capacity in the US, solar is right in any conversation that's being had about that. Now, if you're operating in the US solar market, things look very different to you based on what market segment you're sitting in. So let's look at each market segment individually and trends over the last couple of years, and then build that forward. Starting with residential, it's a good time to be in the residential solar market. It has been a good time to be in the residential solar market in the US for a few years now. And we've been saying this for a while, but it's been interesting to just keep watching it happen over and over again. The residential solar market has been and remains today the smallest market segment for solar in the US as defined by capacity installed. If you look at that relative to, say, press coverage, I think it would be the opposite. Right? We hear a lot about the residential solar market. It's sexy, it's exciting. We have IPOs from companies like SolarCity, so it gets a lot of coverage. It is still the smallest market segment by a relatively fair margin, as you'll see in a second. But it's a really good place to be if you're playing in that market, because on a national level and even to some extent state by state, you see consistent incremental quarterly growth. And as you'll see in a moment, this is not true of any other market segment. So if you're operating in the residential market in the US, it's a lot easier to plan for your business operations, a lot easier to plan for expansion, because you can see a little bit further into the future. Now, the one caveat there, of course, is that the residential market is facing a much more significant threat in the form of changes to net metering, changes to electricity rate structures than any other market segment is as well. So there are real risks inherent in the residential market, but the economics look fantastic across a lot of locations. You have 15 or 16 states where there are multiple companies who can offer a residential customer a lease or a PPA at less than their current retail electricity price, which is kind of the benchmark for one of those markets to be attractive. And then you have a few more states that you might start to see that occur in the next couple of years, right? We haven't actually seen the big residential solar companies, SolarCity being the easiest example, expanding into new state markets a whole lot in the past couple of years. I think you will see that in 2014. The non-residential market is a bit weird, and it particularly has been a bit weird over the past couple of years. Where the residential solar market grew 60% year over year in 2013, the non-residential market, which again is a combination of commercial, industrial, nonprofit, government, and school installations all lumped together, grew only 4% over the course of the year. And if you look at that relative to the recent history of the US solar market or even the commercial solar market, 4% growth is anemic, is painful. It's not shrinking, but it sure didn't grow a whole lot. The thing about that, though, is I don't think every commercial solar company was feeling that pain equally. What was really happening was that we've historically been heavily dependent on a few key states in commercial, and those key states all saw a year-over-year decline for different reasons. California actually saw a year-over-year decline in commercial installations, not because it was having such a bad year, but because California had had such a boom in 2012, thanks to stimulus-funded government projects in particular, that 2013 just looked a little worse in comparison. In New Jersey, you had an actual collapse thanks to SREC oversupply and plummeting prices for SRECs. It was a needed correction in the New Jersey market that is not quite over yet. But again, if you look at that year over year, the boom took place in 2012, the crash took place in 2013. Those two states alone made up the vast majority of the reduction in any states in the commercial market. And then you had a few other markets that picked up and made up for what loss you had in those markets, most notably Massachusetts, which had a gigantic boom toward the end of the year. Also worth noting that depending on your definition of non-residential, you might look at this a little different from how we do. We look at things based on the side of the meter of the project. So any project on the utility side of the meter, selling power into a wholesale market or directly to the utility, that's a utility project by our definition, regardless of size. Some people would classify commercial as anything under 1 megawatt or 5 megawatts, take your pick. That would make things look a little bit different because North Carolina had such a banner year last year, primarily with projects under 6 megawatts, and those projects all on the utility side of the meter. So we call them utility projects, but if you called those non-residential projects, then would it change its picture entirely? Either way, the non-residential market, overall, not a great year in 2013, relatively speaking, but should be a little better again in 2014, and we'll talk about that in a minute. The utility market, and I consistently put this slide up there and then say that it doesn't mean anything, but I do it anyway. Looking at quarterly trends in utility scale solar installations is not particularly illuminating because it's just dependent on when individual large scale projects come online. We did see this massive installation boom in the fourth quarter of 2013, over 1.4 gigawatts just installed in that quarter. But again, it's just pipeline build out, and particularly now as we're seeing a lot of these multi-hundred megawatt utility scale solar projects, many of which got a DOE loan guarantee. Those are in construction now or just beginning operation. Some of them are already online. Those skew these numbers in any given quarter. And that's why the overall figures for either utility scale solar in any given quarter or just total solar installed in the US in any given quarter are often quite misleading because the utility market can just fluctuate so wildly. The key point to make here, though, historically, and then we'll talk about what's going to happen in a little bit, is that despite all the excitement about distributed generation in the US, and I think that excitement is warranted, a lot of the growth that we've seen has come out of the utility market. In terms of megawatts installed, it remains the dominant market segment. More than 50% of all installations in the US have been and will be again this year utility scale. So there's a bit of a disconnect between what we talk about, I think, and what's exciting right now, and then what's actually getting built out. Another thing that we've noticed, and this has been interesting for us because we now have 4 years of pretty granular data quarterly on what's happening in solar in the US, and we now have enough data that we can pretty confidently talk about seasonality, which we had noticed as a trend before, but never had enough data that we felt comfortable stating it as a fact, which I think we can do now, which is that in both the DG market, and as you'll see in a second, and the utility market as well, there are relatively clear seasonal trends. And those seasonal trends are decent first half of the year, nothing special, decent third quarter, perhaps a little bit of an uptick in the third quarter, and then big jump in the fourth quarter. It's actually really easy to explain why that happens in the utility market. It's a little harder to explain why it happens in the DG market. There's some years in which there's an obvious answer. If you have an incentive that is expiring at the end of the year, then obviously you want the project completed by the end of the year, and so you focus on getting a lot done in Q4. There's some companies that want to do it for revenue recognition reasons, for getting something into a particular tax year. There are any number of smaller reasons, but it remains relatively consistent year over year, even when there's no incentive expiring. So don't take your vacations in the fourth quarter, especially if you were in the utility market. So in the DG market, where in the fourth quarter you might see 35% of the annual installations get done, in the utility market it's 50% of the annual installations come online in the fourth quarter of the year. And again, it's easier to explain there because you have more projects for which there is a lot of money on the line that has to get allocated into a particular year or is going to impact a public company's finances for that year, and they focus on getting those projects done. This is, there's two ways to look at what you're looking at right now. This is a map of solar installations in the US in the top 30 states, which is what we track now individually in 2013, broken down by market segment, to scale with the exception of California, which if we made that to scale would just dwarf everything else, so we don't make that one to scale. And this is where I'll admit fault, which is that in 2005, when I would say the birth of the modern solar industry in the US, California was about 80% of all solar installations in the US. So, people talked about solar in the US, they really meant California. When we started tracking the market in detail, 2008, 2009, California was more like 50 or 60% of installations. So we're starting to track the market, we're watching this trend, which is, you could call it geographic diversification. And then we're just noticing that there are some other states where there's a little bit happening, and they're growing in other states, there's new incentive programs being introduced, and we're thinking, this is the trend, this is what's gonna happen in the US solar market, geographic diversification beyond California. And to some extent, we have seen that, but only in the context of other states which begin to install significant volumes. So in 2013, we had 20 states individually that installed over 20 megawatts each. 20 megawatts, by 2008 standards would have been significant. By today's standards, 20 megawatts isn't a whole lot. And some of the states that did 20 megawatts, Indiana being a great example of that, it can be 2, 3 projects, 1 project in some cases can get you there. So, we've seen a little bit of geographic diversification, but let's be honest with ourselves about how much we actually have seen. In the residential market, in 2013, California was over 50% of the overall national market. That's up from 2012. We became more reliant on California in 2013 than we were before that. Now, it's a growing market, so we have lots of states that are growing, just California has grown faster. And as a result, we remain highly geographically dependent on a few key states. California obviously being the biggest one, but the top 5 states alone were 80% of all installations in the residential market. This is not where we want to be long term, both because the market potential in the US is driven by the fact that we have a huge electricity sector and a lot of homeowners, most of whom do not live in these 5 states, but also because it makes us more subject to whatever regulatory or rate structure or any changes that take place. I mean, AB 327, the bill in California that dealt with net metering, if that had gone poorly, if that had been, if the result of that had been a whole lot worse, then that could have decimated the residential solar market in the US in a way that we certainly wouldn't like. And we're fortunate that that bill was, I think, generally speaking, pretty favorable. The non-residential market, still pretty dependent on a few key states. Those states differ a little bit. California, very important, but not nearly to the same extent. New Jersey and Massachusetts both played a huge role as well. And the top 5 states together accounted for 69% of the market. So a little bit less geographically concentrated than the residential market is, but still more than we'd like to be. And so I'll admit here that when in 2009 we were predicting a lot of geographic diversification, we just haven't seen it yet. And it speaks to, I think, the state we are in solar in the US and in the DG market, which is that historically, what drove a market more than anything else, what drove a state to be an attractive solar market was some form of state-level incentive. It was a rebate or a production-based incentive, it was an SREC, it was an RPS, it was something, right? You couldn't make projects pencil pretty much anywhere if you didn't have the ability to stack a federal incentive in the form of the ITC on top of a state-level incentive in the form of whatever that state-level incentive was. So that's always been true, right? And that's why we historically had such high concentration in a few markets. They had the right market structures. There are obviously some fundamental factors too. You want states with a lot of sunlight or you want states with high electricity prices, sure, but that wasn't enough anywhere except maybe Hawaii. We're just starting to head into kind of a new age of solar in the US where that's less and less true. California is the prime example of that. All this growth that we saw in California in 2013, the bulk of it took place outside the California Solar Initiative, which means that those projects that were getting installed benefited from no state-level incentive whatsoever. They benefited from California's high insulation and relatively high electricity prices, relatively attractive rate structures. But I wouldn't consider any of those to be direct incentives for solar. So California is the first market where we're really seeing meaningful volume of installations take place with just federal incentives. That's exciting because if you expand that, if you imagine that there were a lot of states where that's the case, then the addressable market for distributed solar in the US jumps into the hundreds of gigawatts, right? And it's not that easy, and California has a number of things going for it that lots of other states don't. And so California is first, and right now possibly only, right? You don't see many other states with zero state-level incentives that have big DG markets, or even big relative to the size of that market overall. So that's where we're heading. The next 3 years are going to be really important for that, right? Because we want to get to the point where solar is economic, DG solar is economic in as many states as possible with just the federal incentives, and then we'll see what happens when the federal incentive expires, assuming that it does. And we'll come back to that. We'd be remiss to talk about particularly distributed solar in the US without talking about what's happening with net metering. This has been really, for me anyway, a fascinating dynamic over the past couple of years. Initially, you just had a few utilities in a few states where either there was a net metering cap that had to be expanded or just where there was a lot of DG being installed, deciding that they wanted to push back against just a pure expansion of net metering as it stands. Right? And so this was the initial sort of high-profile battles that you saw take place in places like Arizona and California. You saw historically, a couple of other little places, and you could point to little sections on the map here where there were little battles in states that didn't have a lot of DG installed yet. What's different now, I think, is that utilities and this is 22 current proceedings. It's in fact not comprehensive now because there's something going on in South Carolina and a couple of other states here as well. It's happening pretty much everywhere. Anywhere that there is net metering in place, and some places where there isn't net metering in place, there is some form of a discussion, a docket, a bill that is being examined to deal with the future of net metering and the future of electricity rate structures in that regard. Utilities are taking it very, very seriously, even if they don't have a lot of distributed solar on the grid yet, for whatever reason that you can point out. What I said yesterday morning about the disruption they may be facing, that could be it. It could also just be that they see everybody else doing it and they say, oh, we got to get on top of this early. So it's happening all over the place. And this is, I'll come back to what I said a few minutes ago, which is that I think the solar industry has been really impressive in how well it has done in basically every one of these proceedings that has taken place thus far. Anywhere where we have some kind of a resolution to date, I would say is favorable toward the solar industry. In a lot of places, the utilities have just been beaten back entirely. And in other places like California and Arizona, you have the makings of something of a compromise that allows the distributed solar market to continue growing. So we can argue about how effective any given one of those policies have been, but the track record for the solar industry thus far is batting pretty close to 100%. It doesn't necessarily mean it's going to be that way forever, but I think it helps provide some certainty, particularly for investors who are financing projects for which net metering could be changed later on. Here's an interesting question that we've been asking for a while, right? The residential solar market in the US has historically been really diverse in terms of the number of installers. So there have been lots and lots of small residential installers who built the residential solar market. Then, a few years ago, we started to see the advent of a few multi-state players and increasingly national players like SolarCity and Vivint and a few others who keep expanding to new states and growing their market share. And so then the question has been, over the long term, will we see significant consolidation in the residential solar landscape? Will it be comprised of a large number of small installers or a small number of large installers? To date, there has been some consolidation. In 2012, SolarCity was 16% of the overall national residential solar market. The next 5 installers combined, this is companies like Real Goods, Vivint, Varango, and a couple of others, were another 15%. You had 70% or so of the market that was everybody else. A lot of these are companies that are benefiting from some of the advantages that SolarCity and Vivint would otherwise have by partnering with somebody like SunPower or Clean Power Finance. So they have access to financing, they have access to some efficiencies that come with scale, but they're still small local installers. In 2013, we did see some consolidation there. SolarCity continuing to expand at an extraordinarily rapid clip, took up over a quarter of the overall residential solar market nationally. The next 5 also expanded their market share to 20% from what had been 15%. So, still a relatively diverse market, but to some extent, consolidating. Now, the question is, that's historical, and we haven't come all that far yet. So where are we going to be in a few years? And I don't have an answer to that, actually. It's one of the things that we grapple with internally is long-term, how do we see this market being concentrated? There are really good arguments on either side of this, in my opinion. There are people who will tell you that the contractor industry, home contractors, they're all local, right? They sometimes have larger brand names, but they're pretty much local businesses. So why would solar be any different? There's an argument on the other side, of course, that there are lots of things you get with scale that you wouldn't be able to get otherwise. And so companies like SolarCity and maybe whoever enters next, who may have a bigger balance sheet, could benefit and take over. I don't know the answer to it, but I will say that 2014 already has been really interesting in this regard because we've started to see a number of acquisitions taking place in the residential landscape in particular that maybe foreshadow where we're going to end up. So in January, Real Good Solar, which is now known as RGS Energy, top 5 installer nationally, closed its acquisition, which it had announced in late 2013, of Mercury Solar Systems, which is a pretty big residential and commercial installer, primarily on the East Coast. In February, Sunrun made, I think, what was the biggest of all these acquisitions thus far this year, acquired Rec Solar's residential business along with the other associated businesses in Rec Solar, except for Rec Solar's commercial business. So that's split off. Rec Solar Residential is now part of Sunrun. This is a vertical integration play by Sunrun that I think a lot of people were surprised by because historically Sunrun was a service provider of financing and O&M solutions to residential installers. So that was a big move, and there's a lot of questions about why that happened. Some people think that it's a pre-IPO move and that they wanted to get a valuation that looks like SolarCity's. Some people think it was just strategic. It's hard to tell. Either way, that was a big acquisition because it's one of the major service provider players that was building a business model primarily off of the idea of a longer tail of smaller installers acquiring an installer themselves. You saw this happen again in March. NRG acquired Roof Diagnostic Solar. NRG, of course, has had a couple of iterations of its residential solar business, but historically had never been a residential solar installer, had built its business model more like Sunrun's. Then acquired Roof Diagnostics, which was a top 10 residential solar installer, big on the East Coast, and then looking at expansion into the West Coast as well. And then Real Goods made another acquisition of Synetric, which is smaller but was a meaningful player in the Hawaii market. So, fair amount of M&A activity already in 2014 for a market that has been pretty diverse in the past. It'll be interesting to see how this trend continues because, there are still some service providers for smaller residential installers who are holding to their guns and make, I think, a relatively convincing argument that that business model will last over the long term. But we're going to be watching out for more vertical integration plays to see whether everybody's making a bet ultimately that you just need to do everything in order to do anything well. What do we expect to see in 2014 in the distributed market? And then we'll move on to utility scale for a moment. Growth, pretty much everywhere in the major markets with the exception of Hawaii, and we talked a little bit about this yesterday. Hawaii has a number of problems in the market, primarily having to do with interconnection limits. So they're hitting circuit level penetration limits that are limiting the market, and it's slowing down everything, and it's tough if you're an installer in Hawaii. If you're in any of these other markets, you should see pretty meaningful growth this year. The couple trends that I would point to here. First, we expect slightly higher percentage-wise growth in the residential market than the commercial market, though relative to 2013, where again it was 60% overall growth in residential and 4% in commercial, the scales are getting a little bit more balanced here in 2014, and also New York. clearly was the smallest on this list, so coming from a much smaller base, this is going to be the year of the New York solar market. We're pretty confident in saying that. Let's talk about the utility market briefly, and then I'll lay out a few predictions for this year and then let you all have your lunch. So the utility market, like I said before, is where most of the installations have been taking place in megawatt terms, but at the same time, it's been a pretty rough spot for about a year and a half now if you're a utility project developer. The major markets, California, Arizona, and a couple of others, where they had been procuring most of the PPAs for utility scale solar, they hit a point where they had enough in the pipeline that they didn't need a whole lot more for RPS purposes, and so they slowed down new procurement. Haven't seen a lot of new PPAs signed for multi-hundred megawatt projects. There had been a transition toward smaller utility scale stuff in the 1 to 50 megawatt range, but it wasn't adding up to the same rate. And one way to sort of prove that out with data, this is from our utility PV market tracker, is the pipeline replenishment rate, which is basically a way of saying how do you compare installations coming online versus new PPAs getting signed. So how big is the pipeline at any given time of projects with PPAs. And it went negative at the end of 2013 for the first time, which is saying that there were more projects getting completed than there were new PPAs getting signed. So and this is, I think, going to remain negative for a year at least now. So the pipeline, we're going through this period of kind of slowing. What's going to be interesting, though, now is we're starting to see in a few really individual, somewhat unique cases, PPAs getting signed that are not driven by RPS standards, that are purely driven by economics, solar compared with some other resource. So, Xcel Energy in Colorado wants to do this. You saw there's a lot of hubbub made about a SunEdison PPA that was signed a few weeks ago that looked like it was about $45 a megawatt hour. I mean, if we can get down to those numbers, if that's real and there's no sort of upside wholesale market potential, that's competitive. Right? And we may see a new wave of utility scale solar in the US driven not by RPS standards, but by fuel price hedging and any number of other reasons that a utility might be interested in getting a fixed price source of power for 20 years that's pretty reliable. So that'll be a topic, I'm sure, that will be discussed in the utility session at the end of the day today. Now, 5 quick predictions for 2014, and then we'll all go get lunch. First one, we've seen 2 big acquisitions from utility affiliates. This is unregulated divisions of regulated utilities that have purchased commercial or industrial project developers. So the 2 big examples so far, Edison International, which is the unregulated arm of Southern California Edison, purchased SoCore Energy, which was a relatively big commercial installer developer in the Midwest in particular. And then NextEra, which is affiliated with Florida Power and Light, bought Smart Energy Capital. I think we will see at least one more of these acquisitions this year. I wanted to say 2, but I stopped myself just to hopefully be right. And a few names that we'll just throw out there. We have no inside knowledge of this, but names of companies that look to me like they would be attractive if I'm a unregulated arm of a utility. Borrego Solar, Innovatus, which is also sort of a Midwest-based, but has found a really good niche in developing in some markets that fewer people are in. Sundurance, Trinity, Vanguard, those are all more sort of East Coast-focused developers. We could be wrong about the name, but I do think that a lot of utilities right now, particularly through their IPP businesses, are looking at getting into distributed generation. And the trend has generally been that if they're making a full-out acquisition as opposed to just an equity investment, they like commercial because they get it better. Right? They're an IPP that's been building utility-scale stuff. To go straight from there to residential is confusing. And so to the extent that they get into residential, they do it through making an equity investment in clean power finance. So they do it through helping to raise a fund for somebody else. They're not making those wholesale acquisitions just yet, so I think that what we're going to see in 2014 is at least one more C&I developer get snatched up by a utility affiliate. Number 2, I think that the track record, the fantastic track record of the solar industry in net metering battles will remain in 2014. I think you will see no meaningful net metering repeal effort anywhere in the US, despite a lot of attempts in various locations. But I would guess that you will see at least 1 or 2 states that will change net metering to introduce either a fixed charge on the bill, which is what Arizona did and what California opened the door to, or a minimum bill, which is an alternative that hasn't actually been introduced yet, but is discussed in a lot of circles, where if you install enough solar that your meter spins backward below some small number, then you're going to pay that number anyway. I think you will start to see more of that, and that appears to be what the crowdsourced panel agreed with yesterday. Number 3, bigger prediction, also consistent with what I think the audience was voting yesterday in the crowdsourced panel. Every major third-party residential finance company will have a debt offering by the end of this year. This is a pretty big prediction because a few of the third-party finance companies have openly stated that they won't do this. So I'm betting that they're lying about that, or at least that they haven't made the decision yet. I think over the long term, if you are a residential solar finance company, it's not that necessarily debt is better, it's that you want to have a holistic portfolio to offer to residential customers. There are going to be some customers that prefer a loan to a lease. It's just always going to be that way, and particularly as the loan products get better, some customers will want that, and you want to be able to offer it to them. So I think you're going to see pretty much everybody get a product like this into the market, whether it ends up being a big portion of their portfolio or not. Fourth, we're bullish on the prospect of utility scale PPAs outside of RPS requirements, as I mentioned before. So in the second half of this year, we think there will be a few hundred megawatts of these PPAs signed with no RPS in place, or if it's in place beyond the utility's requirement to procure. And fifth, though it's not on here because I was trying to decide what my 5th prediction was going to be, I think that you'll see one major brand name enter the residential solar market this year. This is a company like Comcast or Verizon. This is somebody that everybody knows that is going to start and selling solar to homeowners. There's a number of different ways they could do it. They could be the installer. They could just be the service provider and then subcontract the installation. They could white label somebody else's service solution, but they're going to put their brand behind solar and sell it to residential customers. I think you'll see an announcement like that this year. Comcast is an obvious bet because they already partner with NRG on electricity in addition to everything else that they do. So it's relatively easy to imagine them adding solar, but maybe it's not them, maybe it's somebody else. Finally, 2017, which I haven't talked about a whole lot, is a big question mark. And I put this forecast up here thinking it's probably going to be wrong. This is our forecast for overall solar installations through 2017. You can see a big decline in 2017. Now, as we talked about yesterday on one of the panels, year over year, a portion of that is going to be because there's going to be a rush to complete projects in 2016, and then many fewer getting done in 2017 as a result, assuming the ITC is not extended and that there's no commenced construction placed in service. So to some extent, that's going to happen. You'll also note here that where the biggest impact lies in the utility market, why would you develop a utility project to have a commercial operation date of 2017 right now? Nobody is doing that. In fact, anybody who's signing a PPA for the later years, 2018, 2019, they're building the project for 2016 anyway, and then they're either having a merchant nose, which means it's a merchant project until the PPA kicks in, or they're trying to sign shorter-term PPAs to bridge that gap. But I haven't seen, and certainly not in our project tracking, a single project that is expecting commercial operation in 2017. So that in and of itself is going to make the overall market a lot smaller that year. But the big question mark here is not the number for 2017, it's how big an impact will ITC expiration have. And that's tough to call because a lot of it depends on what happens in the next couple of years with both equipment pricing and soft costs, particularly some of the new financing mechanisms. So can we get to a point where across a lot of locations you have cheap enough financing that you actually end up, sort of trading tax equity, which is expensive, for, say, debt, which could be a lot cheaper, and make up some of the ground lost by losing a 20% hit, taking a 20% hit on system costs as a result of ITC expiration. I will say, regardless, I think what's unfortunate about ITC expiration is even if you have some places where the economics still pencil, as I said before, we're right in this transition period of getting past the point where we need state-level incentives, and we're going to have a lot of markets that are right on the margin in 2017, where the economics will pencil in 2016, but if you remove the ITC in 2017, they won't. So though you could still have some places where the market looks pretty strong, a lot of the momentum we're going to be building in new state markets over the next couple of years is where the biggest risk lies when the ITC goes away. Still, in between now and then, if our forecasts are off for 2015 and 2016, my guess is that they're too conservative. There is a lot to get built out in the near term. It is an exciting place to be in pretty much every market segment and in almost every major state. So with that, I'll leave you for now. We're going to head into lunch, and then we'll come back. And please do stick around. I promise the panels this afternoon are going to be fascinating, really engaging. And this is the last you get to hear from me, or have to hear from me, rather. So thank you very much.